So you know that classic optical illusion, the one psychologists always use in those intro classes?
Oh yeah, right. The old woman, young woman thing.
Exactly, yeah. It's just a simple line drawing, right?
Yeah.
And if you look at it from one specific angle, you clearly see a picture of an old woman. But then if you shift your focus just a little bit, it instantly flips into this profile of a young woman.
Right. And the ink on the page hasn't changed at all.
Right. The lines are identical, but your brain's interpretation of those exact same lines completely flips the reality of what you're seeing based entirely on what you choose to anchor your attention to.
Yeah. It's like the ambiguous cylinder illusion, or even the Rubin vase, where you either see the two faces looking at each other or a single vase in the middle. The underlying mechanism there is exactly the same.
Yeah.
Because, human beings are basically just pattern matching machines. We tend to lock on to the very first recognizable pattern we see, and we completely blind ourselves to the alternative reality that's sitting right there in front of us.
And when you look at Wall Street, specifically at the way the market digests corporate earnings reports, you actually see this exact same psychological phenomenon play out in real time.
Oh, 100%.
Because, an earnings report drops at 4 o'clock in the afternoon, right? The headline numbers hit the wire, the algorithms scan the text, and depending on which specific metric you anchor your attention to, you could look at a company and see a complete disaster.
Right.
Or you could look at those exact same financial statements, read just a few lines deeper, and see a brilliant textbook turnaround in progress.
Which is, it's the primary reason why reading past the headlines is so critical for anyone trying to allocate capital.
Yeah, you have to.
You really do. You have to understand the mechanics of the accounting, the long-term strategy of the management team, and the underlying momentum of what the consumers are actually doing. A single quarter's revenue number, just taken completely out of context, tells you almost nothing about the actual durability of a business model.
Right. And today, we're going to put that exact theory to the test. So welcome to this Talk Tickers edition of the Deep Dive.
Glad to be here.
Our objective today is to break down the Q2 2026 earnings call for The Honest Company, which trades under the ticker symbol HNST.
HNST, yep.
We're going to basically cut through the Wall Street jargon, pull out the raw financial data, and explain the operational reality behind those numbers.
And hopefully provide a really clear, actionable perspective for you on whether this stock is a buy, a hold, or a fold.
Exactly. Because this specific earnings call, it basically serves as a perfect real-world application of that optical illusion concept we were just talking about.
It really does, because if an investor just, skimmed the very first line of their income statement, the immediate assumption would be that this is a consumer packaged goods business in severe contraction.
Yeah, they'd panic.
Right. But when you unpack the actual operational mechanics of what management is executing right now, you find one of the most fascinating demographic pivot stories currently happening in the whole retail sector.
Okay, well, I'm going to need some convincing on that front, because we really have to hit this top-line contradiction immediately.
Let's do it.
Because looking at the data provided by CEO Carla Vernon and CFO Curtis Bruce, reported revenue for the second quarter was $83.3 million.
Right.
Which that actually represents a decrease of 10.9% year over year.
Yeah, almost 11% down.
Right. So as someone looking at this stock, my immediate reaction is just heavily skeptical. Revenue's down double digits.
Yeah.
A shrinking business is rarely a winning investment thesis. So how does a company lose nearly 11% of its sales volume and still pitch the quarter as this massive victory for shareholders?
Yeah, that reaction is incredibly common, and I think it perfectly highlights the difference between reported accounting metrics and, underlying business health.
Okay.
Because that 10.9% reported drop, it is factually accurate, but it's heavily distorted by what we call Wall Street noise.
Noise, right. So what's the signal then?
Well, you have to look at the composition of that reported revenue. So over the past year, The Honest Company has been engaged in this really deliberate strategy of just shedding dead weight.
Okay.
That top-line revenue drop, it actually includes strategic exits from international markets that were just, bleeding cash.
Gotcha.
And the discontinuation of underperforming product lines. But most importantly, it includes a major, highly calculated shift away from segments of their core diaper and baby apparel business.
Wait, I need to push back on that last point.
Go for it.
Their brand identity is literally built on diapers.
Mm-hmm.
Jessica Alba founded this company specifically because she couldn't find safe, chemical-free diapers for her own children.
So that's the origin story, yeah.
Right. So the honest company, without a heavy focus on diapers, that sounds to me like Nike suddenly deciding to pivot away from sneakers.
I get that.
I mean, isn't there a massive risk in alienating their core loyal mom demographic just to, trim the balance sheet?
Well, sure, there's always a risk in shifting a brand identity, but there's a much larger risk in ignoring macroeconomic reality.
Okay, explain that.
To understand this decision, you really have to look at the brutal mechanics of the diaper business itself. It is just incredibly capital intensive.
Because of the materials.
Materials, yeah. You're dealing with volatile raw material costs for things like pulp and cotton, but also just massive manufacturing facilities and vast amounts of physical space required for shipping and warehousing.
Oh, right. Diapers are bulky.
Exactly. Diapers take up a ton of room on a truck. And, more importantly, they take up a ton of room on a grocery store shelf.
And grocery stores operate on these razor-thin margins themselves, right? Usually around 1 or 2% net?
Yep, very thin.
So they charge brands these things called slotting fees just to secure that premium eye-level shelf space. I would imagine competing for that space with legacy giants is just incredibly expensive.
Oh, it's a financial bloodbath. I mean, you are going up against Procter & Gamble with Pampers and Kimberly-Clark with Huggies.
Right.
These are massive conglomerates with multi-billion-dollar marketing budgets. They have century-old supply chains. But honestly, even beyond the competition, CEO Carla Vernon pointed out a much more alarming trend on the earnings call.
What's that?
The entire diaper category is actually in a state of structural decline.
Oof. When a CEO uses the phrase structural decline, that usually means the deterioration isn't just because of a temporary economic recession or a bad marketing quarter.
No, not at all.
It implies the fundamental mechanics of the entire market are deteriorating permanently.
And in this case, that structural decline is being driven by demographics. The birth rate in the United States has just been steadily falling since the 2008 financial crisis.
Right. Millennials and Gen Z are delaying parenthood.
Having fewer children or just, opting out of parenthood entirely. So if the total addressable market of actual babies is physically shrinking every single year, fighting for market share in the diaper aisle means you are fighting for a slightly larger slice of a shrinking pie. Continuing to pour millions of dollars of capital into that specific category, it's basically a race to the bottom.
Okay, that makes a lot of sense. So management made a capital allocation decision to trim their exposure there.
Exactly.
And they also announced they're transitioning their baby apparel and bedding business to an outsourced licensing model. I want to make sure I understand the mechanics of this, though.
Sure.
So instead of designing, manufacturing, storing, and shipping all those baby clothes themselves, they're handing that entire operation over to a third-party manufacturer.
Yep, they are partnering with an industry-leading apparel manufacturer who basically handles all of the heavy lifting. The honest company just collects a licensing fee, like a royalty, for allowing their brand name and designs to be used.
Okay, so it sounds really similar to moving from owning an independent restaurant to franchising it.
Oh, that's a great analogy.
Because when you own the restaurant, you're responsible for buying the raw ingredients, right? You're paying the kitchen staff, you're replacing the broken ovens. It requires a lot of working capital.
Constantly draining cash.
Right. But if you transition to a franchise model, you stop paying for all of that overhead. You just collect a royalty check for letting someone else put your logo on the building.
Exactly.
So your top-line revenue might look much smaller because you aren't counting the gross sale of every single hamburger, but the actual profit you take home is much higher, and it involves virtually zero risk.
That is a highly accurate comparison. In the consumer packaged goods industry, we call this an asset-light model.
Asset-light.
Yeah. By shifting the apparel side to a licensing agreement, Honest eliminates the inventory risk completely. Because, think about it, baby clothing is seasonal and it's highly subjective to fashion trends.
Right.
If you manufacture too many, say, winter onesies and they just don't sell, that inventory sits in a warehouse tying up your cash. And eventually, you have to discount it heavily just to get rid of it.
Just to clear the space.
Right. Licensing removes that working capital trap entirely.
Okay, so that totally explains the intentional drop in total reported revenue. But if they are shrinking those specific categories, what tells us the business isn't just, slowly dying overall?
Well, this is where we have to isolate the organic revenue metric.
Organic revenue.
Right. Organic revenue strips out those strategic exits and those licensing transitions. It just measures the sales from their core ongoing business, the products they are actively still trying to sell themselves.
Okay, and what did that look like?
On an organic basis, revenue did not shrink. It actually grew by 6.7%.
Oh, wow. Okay, so in the current macroeconomic environment, generating nearly 7% organic growth in consumer goods is incredibly robust.
Very strong.
Especially considering how much consumer discretionary spending has been under pressure lately from inflation.
Exactly.
But, the top-line stabilization is really only half the story here. Because the profitability metrics from this quarter are just staggering.
You really are.
Net income hit $10.7 million. And for context for you listening, in the exact same period last year, net income was just $3.9 million.
Which is a huge jump. But, net income is a great headline figure. But the metric that truly validates this turnaround is the free cash flow.
Oh, absolutely. Looking at the first half of the year, they generated $35.3 million in free cash flow.
Right.
And last year, they were at a negative $3.8 million.
Yep.
So they literally went from bleeding cash to generating over $35 million in just 6 months. And because of that, they're now sitting on a balance sheet with $105.9 million in cash and cash equivalents, carrying absolutely zero debt.
Which is incredible. Free cash flow is really the ultimate truth teller in corporate finance.
Yeah, it's hard to hide.
Exactly. Management teams can legally massage earnings per share, through accounting depreciation schedules or adjusted tax rates.
Right. Paper profits.
Exactly. Paper profits. But free cash flow, which is the actual cash left over after paying for all your operating expenses and your capital expenditures, that cannot be faked. Cash in the bank is cash in the bank.
Right.
So moving from negative territory to a positive $35.3 million means the underlying mechanics of how they source, manufacture, and sell goods have been fundamentally repaired.
So where exactly is that efficiency coming from? Because looking at the gross margins, they reported an adjusted gross margin of 50.1%.
Which is huge.
Yeah, for a company manufacturing physical goods, bottles of lotion, packs of wipes, breaking a 50% gross margin is borderline software company territory.
It is an exceptional number, but we do have to apply the same rigor here that we applied to the revenue numbers earlier.
Okay, what's the catch?
That 50.1% figure actually includes a significant one-time benefit that sort of masks the true operational baseline.
Ah, right. The $6.6 million tariff refund.
Yep, that's the one.
The government basically refunded them for import taxes they had previously paid. But why was a baby brand paying heavy import tariffs in the first place?
So it traces all the way back to the Section 301 tariffs that were imposed on Chinese imports over the last several years.
Okay.
Many consumer goods companies, particularly ones dealing in textiles and apparel, historically relied on Chinese manufacturing just because of the low labor costs and, really established supply chains.
Right.
So when those tariffs hit, it immediately compressed margins across the entire CPG sector. Companies basically had three choices. They can either pass the cost onto the consumer, they could just eat the loss themselves, or they could go through the really arduous process of moving their supply chains to other countries, like Vietnam or India.
So what did Honest do?
Honest navigated this by filing for exemptions and refunds wherever they were applicable, and this quarter, that cash finally hit the balance sheet.
Okay, so that $6.6 million was essentially a windfall. It's real cash, obviously, but it's not repeatable.
Exactly. It's a one-off.
So if we remove that tariff refund and we remove the minor dilution from liquidating their old apparel inventory, what is the underlying repeatable gross margin of the business right now?
The underlying adjusted gross margin landed at 43.8%.
Okay, but that is still an improvement of 340 basis points, or 3.4% year over year.
Yep.
That means on every single dollar of product they sell, they're keeping an extra 3.4 cents of profit compared to last year.
Right. And that gross margin efficiency, it cascades all the way down the income statement to their underlying adjusted EBITDA margin.
Right. Let's break that down for a second.
Sure.
EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
It's a mouthful.
Yeah, it is. But it's essentially a proxy for how much cash the core operations are spitting out before the accountants, the banks, and the government take their respective cuts.
Exactly. And their underlying adjusted EBITDA margin hit 9.8%.
which CFO Curtis Bruce noted on the call is actually the highest underlying adjusted EBITDA margin in the entire history of the Honest Company.
Record-breaking.
Right. So we have a situation here where a company engineered an intentional drop in total reported revenue. But their organic sales are growing, their cash flow has swung positive by nearly $40 million, and they are achieving the highest profit margins they have ever recorded.
And this is the exact moment where the optical illusion flips.
Right.
The headlines say the business is shrinking, but the actual mechanics say the business has never been healthier. The fundamental question for an investor is, well, how did they manage to shrink their way to record profitability?
And that requires looking at the demographic pivot. Because reading through this transcript, it really seems like management realized that being categorized strictly as a quote-unquote baby brand was actually a straitjacket for them.
Totally.
They seem to have figured out that the real margin expansion isn't in the nursery. It is actually in the adult bathroom.
It's a fascinating evolution, honestly, of a brand just transcending its origin story. Because the Honest Company was built on a very specific premise: safe, clean, non-toxic products.
Right. The Jessica Alba story.
Right. And initially, the most desperate demographic for that specific value proposition was new parents. I mean, when you have a newborn, you suddenly become hyper aware of all the chemicals and the lotions and wipes you're using.
Oh, definitely. You read every label.
But the cultural zeitgeist has really shifted over the last decade.
Yeah, millennials and Gen Z are now applying that exact same hyper-awareness to the products they use on themselves. The demand for clean ingredients, transparent supply chains, paraben-free cosmetics, that has absolutely exploded into the mainstream adult market.
And that is exactly the trend Honest capitalized on, because they systematically shifted away from those low-margin, capital-intensive baby categories we talked about. Their higher-margin wipes and personal care platforms now constitute over 70% of their total revenue.
I really want to focus on that 70% figure for a second, because 3 years ago, this was widely perceived by everyone as a diaper and baby lotion company.
Yep.
Today, 7 out of every $10 they make comes from wipes and personal care.
It's a massive shift.
It is. And the growth numbers driving that transition are wild. I mean, the overall wipes category in the broader market grew by a very modest 2%.
Right. Pretty flat.
But Honest's total wipes portfolio grew by 26%. Their sanitizing wipes grew 55%, which, by the way, makes them the second largest hand sanitizing wipe brand in the entire category.
Those are really strong figures, but honestly, the flushable wipes data is where the true disruption is happening.
Oh, man. Flushable wipes exploded by over 200% in the second quarter.
200%.
Growing any physical product line by 200% in a single quarter is hyper-growth territory. I do struggle a bit to understand the consumer psychology here, though. Why are adults buying a baby brand for their own bathrooms? And how did Honest manage to capture that market so quickly?
It really comes down to expanding their total addressable market.
Yeah.
CEO Carla Vernon presented a demographic statistic on the call that I think completely reframes the ceiling for this entire company.
What was it?
She noted that 89% of households in the United States do not have any children under the age of 7.
89%.
89. Furthermore, 75% of all U.S. households have absolutely no children at all.
Wow. Okay, so if you position yourself purely as a baby brand, you are essentially engaging in a vicious price war over just 11% of the population.
Exactly.
But if you position yourself as a premium, clean ingredient personal care brand, you suddenly open up the other 89% of the country.
And the data indicates this strategy is working beautifully, because Honest increased their overall household penetration to 8.1% this quarter.
Meaning 8.1% of all homes in the U.S. purchased an Honest product.
Yep, that's an increase of 100 basis points. But the most critical detail, which was kind of buried in the report, is that nearly 2/3 of that new household growth came from households with absolutely no children.
See, this is the core of the bullish thesis for the stock right here. They were successfully crossing the chasm from being a niche parental purchase to becoming a mainstream adult household staple.
Exactly.
But how exactly are they achieving that transition? It can't just be word of mouth, right?
No, it requires a massive shift in their marketing tone and their retail strategy. You can't effectively market to a 30-something adult without kids using, soft pastels and pictures of sleeping infants.
Right. It just doesn't resonate.
So management launched a major campaign specifically for their flushable wipes called It's Time to Get Honest.
I've seen those ads.
Yeah. It was edgy, elegant, slightly irreverent, and it was targeted squarely at adult consumers buying personal care products for themselves.
And the campaign clearly resonated. I mean, they reported it generated over 3 billion media impressions.
3 billion.
But marketing only really works if the product is physically accessible when the consumer is actually ready to buy.
Right, which is why their retail placement strategy is so crucial here. They didn't just redesign the packaging and leave the flushable wipes sitting in the baby aisle.
Where'd they put them?
They actively secured distribution in the feminine care and adult personal care aisles at major pharmacies like CVS.
Oh, that is a brilliant real estate play. Because the baby aisle is essentially a dead zone for anyone who doesn't have a child.
Totally.
You do not wander down the diaper aisle on your way to pick up toothpaste. Yeah. But the personal care aisle is super high traffic. So they're meeting the adult consumer right where they organically shop.
And they also redesigned the physical packaging of the wipes to act more as a room accessory.
A room accessory.
Yeah, they designed the dispensers to look sleek and aesthetically pleasing in a modern adult bathroom, deliberately moving away from those bright, cartoonish aesthetics that are usually associated with baby products.
That is so smart. And yet, while they're aggressively chasing this new adult demographic, they don't seem to be abandoning the children who are already in their ecosystem.
No, not at all.
They seem to be extending the life cycle of the customers they already have. I noticed they recently timed the launch of their kid-friendly personal care lineup, which they refer to as the Big Kid Aisle, with the premiere of the upcoming Toy Story 5 movie.
Yeah, that's a huge partnership.
They partnered with Pixar on a media campaign to tap into that multi-generational nostalgia. And they launched this line in Walmart and Amazon and are now expanding it into regional grocery powerhouses like HEB down in Texas.
Which, from a customer acquisition cost perspective, that is a textbook strategy for maximizing lifetime customer value.
Explain how that works.
Well, you acquire the customer initially when they buy clean, conscious baby wipes for their newborn, right? Then, as the child grows into a toddler, you transition them to the Toy Story branded body wash. And simultaneously, because the parents already trust the brand's ingredients, you cross-sell those parents flushable wipes and sanitizing wipes for their own use.
Oh, wow.
So you basically turn a 3-year customer relationship into a 20-year household relationship.
That is incredibly efficient. Which brings us naturally to the forward-looking aspect of the call.
Let's talk guidance.
Because we've established that they are shedding dead weight, right? They're executing a demographic pivot, achieving record margins, and they're sitting on a massive pile of cash. The vital question for an investor is what management plans to do with all this momentum. Did they update their guidance for the rest of the year?
They did, and they raised their full-year expectations across almost every major metric.
Okay, let's hear the numbers. Their updated full-year 2026 outlook projects reported revenue to land somewhere between $319 million and $325 million. Now, it is important to note for listeners that this figure includes a temporary $10 million boost from liquidating that old apparel inventory we talked about as they shift to the licensing model.
Good catch, yeah.
But looking at the organic side, they bumped up their organic growth forecast to a range of 5% to 7%, which is up from the previously stated 4% to 6%.
And that upward revision really just reflects management's confidence that the momentum we saw in the first half of the year is going to continue to accelerate in the back half.
They also raised their profit expectations. Adjusted gross margins are now expected to land in the, quote, mid-40s, which is a notable upgrade from the previous guidance of low 40s.
Huge jump.
And adjusted EBITDA is raised to a range of $23 million to $25 million, up from the prior range of $20 to $23 million.
And you know, this guidance introduces a really interesting capital allocation dynamic, specifically regarding that $6.6 million tariff refund we discussed. Well, management had a choice. They could have simply let that cash fall to the bottom line, artificially inflating their end-of-year profits to make the executives look really good on paper.
And the analysts on the call actually pressed them on this exact point during the Q&A session, didn't they?
They did, yeah.
Aaron Gray from Alliance Global Partners asked about the profit guidance for the second half of the year, pointing out that the math seemed to imply a massive step up in their operating expenses.
Right. And Carla Vernon and Curtis Bruce confirmed that the increase in spending is entirely intentional. They are taking the millions from that tariff refund and they are aggressively reinvesting it back into the business.
Meaning marketing.
Yeah, they announced plans to increase their marketing spend by nearly 20% in the second half of the year.
So they're essentially pouring gasoline on this no-kid demographic fire.
Exactly.
Because they have proven that when they deploy marketing dollars to target adults with flushable wipes and personal care products, the consumption goes up and the household penetration expands.
Right. The unit economics work.
So they have the extra cash. And they're utilizing it to drive even deeper market penetration heading into 2027.
And they're being very strategic about where in the marketing funnel they're deploying that capital.
What do you mean?
Well, in digital marketing, you have a lower funnel spend, right? Which is directly tied to a point of sale things like sponsored search results on Amazon or, targeted Instagram ads with a big buy now button.
Right. Highly efficient for immediate conversion.
Exactly. But Carla Vernon specifically highlighted a major investment in upper funnel marketing.
Upper funnel marketing being those broad brand awareness campaigns that are designed to educate the public rather than just drive an immediate click.
Precisely. So they launched a new umbrella campaign titled The Mother of All Standards.
Get you.
Yeah, and the goal of this campaign is to educate the broader consumer base on their really strict formulation standards. Specifically the fact that they have a list of 3,500 banned ingredients that they absolutely refuse to use in any of their products.
Oh, wow. 3,500.
Yeah. They are investing heavily to ensure the public understands that Honest is a modern, clean formulation personal care company, not just a diaper manufacturer.
There was a moment during the Q&A session that I thought truly illuminated the scale of the opportunity here.
Oh, to part.
Anna Glaskin from B. Riley Securities asked a question regarding household penetration and retail distribution. She basically wanted to know how much runway the company actually has left to grow.
Right. And the response from the CEO really provided the context needed to understand why Wall Street is reacting so positively to this turnaround.
Yeah, Carla explained that while the brand's overall household penetration is 8.1%, you really have to segment that out by category to see the growth potential.
Right. It's not evenly distributed.
No. In baby personal care, where they are currently the number 2 brand in the entire aisle, their penetration is less than 3%.
Which is wild.
And she noted that some legacy competitors are in 6 times as many households. But the truly staggering metric was for the flushable wipes. Because despite already being the 4th largest brand in the flushable wipe category, their household penetration is currently less than 1%.
Less than 1% of United States households. And they've only been competing in that specific category for roughly 3 years.
Exactly. And this is honestly the most actionable data point from the entire call for me. Carla noted that every single percentage point of household penetration they gain in these specific categories equates to anywhere from $20 million to $30 million in annual incremental sales.
Boom. That is the exact mathematical equation that excites institutional investors.
Yep.
Because think about it. You have a high-margin product. It is growing at 200% year over year, and it hasn't even reached 1% of the population yet.
The runway for top-line revenue growth is massive.
Massive. And because they've spent the last year just ruthlessly fixing their underlying supply chain and operating expenses, consolidating warehouses, transitioning away from owned apparel manufacturing, streamlining their corporate overhead, that incremental $30 million from new households doesn't get eaten up by administrative bloat.
It drops down.
Yeah, a massive portion of it will drop straight to the bottom line.
So when you strip away the noise of the strategic exits and the one-time tariff refunds, you are essentially looking at a management team that has engineered a highly scalable, highly profitable machine.
Absolutely.
And that leads us to our final verdict on the stock. In this format, our goal is to synthesize the data into a really actionable perspective for you.
So what's the call?
Based on the mechanics we discussed today, my view on this earnings call is that it is a highly, highly bullish signal for the company's future. If you are an investor holding or considering a position in HNST, the primary takeaway is that the market needs to stop pricing this equity like a struggling, cash-burning baby company that's desperately trying to maintain market share against Huggies.
The data simply does not support that narrative anymore.
It really doesn't. They are a profitable, cash flow positive personal care brand that has successfully pivoted its core demographic toward the adult market.
And, the evidence strongly supports a bullish interpretation here because the consumer goods sector is honestly just littered with the remnants of direct-to-consumer brands that went public with these massive valuations and eventually flamed out.
Right, because they could never figure out how to make their unit economics work in a traditional retail environment.
Exactly. But the Honest Company appears to have completely solved that puzzle. They made the difficult, unpopular choices. They trimmed their exposure to structurally declining categories. They utilized an asset-light licensing model to free up their working capital, and they ruthlessly redirected their resources to dominate the high-margin adult wipes and personal care spaces.
And they executed this entire turnaround while maintaining an incredibly pristine balance sheet.
Zero debt.
Zero debt. Holding over $100 million in cash with zero debt provides just an enormous safety net. And generating over $35 million in free cash flow in just 6 months proves the model actually works.
They're even utilizing some of that cash to buy back their own stock, too. I think they've repurchased 5.6 million shares this year.
Right. So the financial foundation is durable, and it's primed for aggressive reinvestment.
Management has successfully constructed the exact kind of virtuous cycle that long-term investors are always searching for.
Right. Improved operational efficiency generates excess cash flow.
That cash flow funds aggressive marketing. The marketing drives deeper household penetration. That penetration results in higher margin revenue, and then that revenue funds further operational efficiency and product development. It just feeds itself.
It is a remarkable case study in corporate reinvention, and it leaves me with one final kind of provocative thought regarding the long-term endgame for this stock.
Let's hear it.
If the Honest Company can successfully maintain this trajectory, if they truly cement themselves as a clean ingredient staple in every adult's bathroom across the country, operating with zero debt, soaring gross margins, and just massive runway in multi-billion-dollar categories.
The logical conclusion is that they become an incredibly attractive acquisition target.
Right. I mean, how long will it be before a legacy CPG conglomerate companies like Procter & Gamble or Unilever, who constantly struggle to organically create millennial and Gen Z friendly brands, looks at this pristine balance sheet and decides that buying the Honest Company outright is just cheaper and faster than trying to build a clean ingredient competitor from scratch?
It makes perfect sense.
History shows that when a brand does the hard work of turning an optical illusion into a highly profitable financial reality, the industry titans eventually pull out their checkbooks.
Always happens.
Keep your eyes on the ticker. We will catch you on the next deep dive.